Hello everyone. My name is Carolina. I am a postgraduate student at the University of Oxford, specializing in international development. I'm an ex-GGI fellow and now a teaching assistant. It's a pleasure for me to introduce Shatakshi to you. Shatakshi is the co-founder of GGI, ex-BCG, advisor to Tony Blair, ex-US, UK Prime Minister. How are you, Shatakshi?
I am doing really lovely. Carolina, really excited to be doing this session with you and happy to answer all the curiosities you have around economics, finance, and career development.
Perfect. And I think we're off to start. Today, I would like to understand a bit more about the inflation situation in the US and the fact that this is having, especially on Indian financial markets. So just to set the context for our audience, could you please explain to us a little bit more about what's happening with inflation in the US and why we should worry about it?
Sure, that's a really good question and a very valuable question as well. So largely the US inflation, at least in terms of year-on-year basis, has touched a mark which has never touched in the last 2 or 3 decades, and that's almost in the range of 6 to 7%. For context, at least in US, the good benchmark or a ballpark number is somewhere around 2 to 3%, right? So you're almost at a 3x number than what is tolerable inflation. I would also just take a minute to help not just you, but the audience understand what is inflation, because I understand that many of them could be engineers or from non-finance background. So inflation largely is basically the rising cost of goods and services, right? So for example, today, if you want to take a flight ticket from Mumbai to New York, right? And if it costs you X, and because of inflation, the price is rising at 3X, right? So it will probably cost you 3X. So that rising cost of goods and services is basically what inflation is. Now, even though I took an example of a flight here, inflation has a more rudimentary connotation to the needed goods and services. So your pulses, your wheat, your grain, things without which you cannot survive, right? So that's why inflation is a very big challenge. There are so many conversations going around about inflation, but I think people still do not really understand or appreciate or understand the adversity around inflation. Not everyone can afford a food on their table on a daily basis. Not everyone can afford to take a break or can afford to go on a vacation, right? So that means people who are at the bottom of the pyramid, they get hit the hardest when the inflation hits them. So I just wanted to bring that out as well.
Thank you so much. That's a very important point to make, I believe. My second question relates to something, I guess, that happened very recently in the US. So after Federal Reserve Chair Powell announced that the Fed's asset purchase program will be reduced in the months ahead, bond yields declined sharply. And actually was the real yield on bond that has fallen. And this generally reflects a change in expectations about supply and demand conditions in the bond market. So if the government is expected to borrow less, then yields should fall. And government borrowing is indeed expected to decline next year, but that expectation was likely already baked into yields prior to Powell's announcement. So what then explains the recent sharp decline in yields according to you?
Sure. That's a really great question, Carolina. Thank you for actually sharing that. And we were discussing behind the cameras how interesting and how tricky this question is. And once again, for context, because I do understand a lot of people may not just be aware what is a bond, what is a yield, how is it really different from the stock market, right? So largely, I would want just oversimplifying things here, right? So there is bond and there is equity, right? These are the two markets from which you can raise your money. Bond is basically a debt market where you're actually raising the money. The governments actually raise the money or the banks take the money from you. And then there is the equity market. If you have been investing your money via these really cool Gen Z apps such as Rota and investing your money in the small case or the big market cap organization, that's the equity market. But there is this another non-cool market as well, which is the bond market. Now, what does really the bond market do? The bond market basically says that, hey, Carolina, why don't you purchase this paper from me? This paper actually costs you $1,000, but in exchange of that $1,000, I'm going to be paying you $100 every year for the next 20 years. So the government will actually purchase or take money from Carolina in the hope that I will use that money as government for the infrastructure investment of this country or for the new development of this country. So that's largely the bond market, right? And you as consumer or citizen of this country will be able to earn some amount because you gave that money to the government. Now that's bond, right? Different from equity. Now what is yield? Yield is basically the $100 that you earned on that $1,000 investment in year one. So that's yield. A return on investment is your yield. Coming back to your question is, recently the Fed is the central bank. There is central bank and there are member banks. The federal bank, Fed here, which is the central bank synonym in US, kind of controls the entire monetary policy ecosystem of US, right? Similarly, RBI controls the entire monetary policy ecosystem of India. What is monetary policy? At what interest rate can I get a housing loan? At what interest rate can I get a home loan, right? Or a car loan, even though it may change bank by bank, but largely there is something called repo rate, for example. Not to take things on a tangent, but largely these things are decided by the central bank. Now the Fed in this case, right, what has Fed done? Fed has basically reduced the supply of the bonds in the market, right? So the Fed is basically saying that we are not going to be purchasing so many bonds that we used to purchase from the member banks before. And what should happen? And Carolina, you're absolutely right? You are basically saying that because there is less supply of bond in the market, your yield should have increased rather, but it has decreased. For that, I will have to share my screen, Carolina, because I will be helping you and of course the other users whosoever would be watching us to understand what is yield. So let me just very quickly share my screen. Let me know if the screen is visible. So I'll just use a whiteboard for the point of view of simplicity. Can you see this? I will clear this. So basically what is yield bond, right? The bond of the yield. Yield bond is basically, pardon my handwriting on a cursor, is the coupon rate divided by the bond price. Now, just an example that I gave to you, coupon rate is basically $100 that you're getting year on year. So that's 100. And then there is bond price. So for example, if the bond costed you $1,000 upfront, that's the bond price. You are saying because the Fed is purchasing less, right? So let's draw a simple supply and demand graph to help you understand here. So for example, this is your demand graph D, and this is your supply graph S, right? In an ideal scenario, your bond price P will be the intersection point here, P. And because you are saying that there is a decline in the supply of bond, because the Fed is saying, I am going to be purchasing less bond from the member banks as I previously did, you would anticipate a supply shock, right? And hence you would say that, Shatakshi, my new price P is less than P. And hence, because the price goes down, the yield should go up. Very valid, right? Most of the people would anticipate that. But mathematically, there is something else happening here. Carolina, if I were to ask this question to you, right? What is the other part in the equation apart from supply that could change your price?
Demand.
Perfect. Correct. So there is an equation of demand as well. What we are largely saying is, if the delta by which your supply is changing is by X, right? Your demand, which is this line, is actually changing by a larger magnitude, which is X by the amount X plus. And hence your new price P is this intersection point, which is, I would call P prime. Because your price has now finally increased and decreased, hence your bond yield would be decreasing. So very mathematical point of view, let me bring intuition to it. You may ask me, Shatakshi, that I understood that the demand is increasing for the bond, but why largely the demand is increasing, right? And that's where the entire concept of globalization come into place. We are not in 1800s or 1700 where there would be depression in one part of the world and the other part of the world may not witness it. A large part of US monetary policy and the impact of it is coming from China. So what is largely happening in China because of the pandemic, because of the financial institutional ravages and the housing potential crisis that's happening there, a lot of investors are finding the bond market more lucrative in US rather than put their money in China, right? Another case in point is, and that's why the financial institution investors, FIIs in India, have been largely investing heavily because there are less lucrative opportunities in China. And hence this demand, right? The magnitude by which there is a demand shock that has taken place is way above than what the supply shock is taking place. And hence there is a bond price increase. I'll take a stop here. I know it was very, very mathematical, but I hope that helps in answering your curiosities that were very valid, Carolina.
Thank you so much for that explanation. And because you just mentioned integration of financial markets, and because we started with red hot US inflation figures, my next question would be, these figures are point of concern for India specifically, according to you?
Subscribe right now so that you get notified every time, every day, whenever I'm putting up my videos on career advancement, personal finance, and lots of productivity hacks.